Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week we had a pretty significant shift with regards to some of the underlying fundamentals of the equity markets with Chairman Powell's testimony in Congress with a fairly decisive dovish pivot in terms of language that we've heard from Chairman Powell. His words were that we were not far from being able to cut rates and that he believed that we were well above neutral with regards to where we are in terms of interest rates. And that simply puts us in a position where equity markets continue to grind higher here, because that's obviously a positive here for equity markets for interest rates to be declining. But some of the things that we have seen in the equity markets, which are signs of exhaustion, higher highs in price, no longer being confirmed by higher highs in price, continue to show itself in the major equity indices. Looking at the S&P 500, looking at the NASDAQ 100, you have the same signals of exhaustion that simply are signs that we are near a market top. That certainly exacerbates the probability of a short-term pullback here in the equity markets. So those are some of the warning signs that we continue to see as the markets kind of grind higher here on the back of what has been fairly good news, positive news, both from a federal perspective, from a macro perspective, looking at the Federal Reserve, as well as looking at earnings season. S&P 500 earnings seasons largely over, seeing that the S&P as a cohort has grown revenues by about 4% and bottom line by about 4% is positive for the overall markets. But the thing to remember is that the equity markets have risen more than 4% over that same 3-month period. So the growth that we've seen here in equity prices is due to margin expansion rather than simply just earnings and revenues growing at a specific pace. Looking at the Russell 2000, last week we talked about the fact that Russell 2000 is potentially breaking out to new recent highs. We did get that breakout here, but as of yesterday's close, we kind of ended up closing just shy of that level. And again, the same type of negative divergence that we see here, higher highs in price, now being confirmed by momentum here to the upside, showing us that small caps struggling to break out higher here, struggling for the broadening out of this rally is one of the concerns that I have with the overall equity markets at the moment. Looking at equal weight, we see the same thing. Equal weight showing some signs of broadening out, where it's not just the equal weight S&P, it's not just the market cap indices that are breaking out higher. Equal weight is confirming that move higher, but we also see that same level of exhaustion here to the upside. So you do see broadening out, which is positive for the overall market. But the question is whether that broadening out can continue and support this rally, or there are some signs that that broadening out is starting to reverse. If we look at the ratio of growth versus value stocks, we have seen value actually outperform growth. What has historically been growth outperforming value over the past 3-4 weeks have actually shown as value outperforming growth. That again speaks to the broadening out of that rally. But is this going to continue where growth starts to outperform value here again? That's yet to be seen. But if you look at the overall picture here, we have seen periods of consolidation in the past where value has outperformed growth, but then the overall the primary trend here is still for growth to outperform value. So even though in the past 3 to 4 weeks you see this broadening of the rally, which overall would be supportive of the rally, starting to see potential signs where that could be coming to an end soon. Commodities, we talked about the fact that commodities was starting to break out here last week. But as you can see this week, starting to pull back into that trading range here again. We'll see at the end of this week if we do end up above that overall breakout here. Gold obviously being the primary driver of this particular move at the moment. So we'll see whether that continues or not. Taking a look at high yield bonds, we've talked about this fact that high yield bonds have consolidated for nearly 3 months after what has been a big move here to the upside. But after that big move here to the upside, starting to break out here. So that's been a positive risk on signal that we've seen from the bond markets that could be positive for the equity markets. However, if we look at the VIX here, one of the things that's showing the market stress or concerns around the market stress is the fact that as equity markets reach all-time highs, the VIX is also trading to relative 3-4 month highs. That really speaks to the angst and the fear that investors currently have with this market rally. The fact that we're trading in that 15 handle, even though the S&P 500 and the NASDAQ 100 are just within spitting distance of all-time highs, shows us that investors are demanding protection here in this market, are paying substantially more for put protection here in this market condition, and willing to pay more for that put protection because perhaps there's a higher anticipation of a pullback here in the equity markets. So even though we continue to see positive overall signs for equity markets, the stresses underneath continue to build. 10-year yields stabilizing around 4.1% here, which is kind of in a bit of an equilibrium here. We've been as low as 3.8, as high as 4.3, 4.1 to 4.0. This range tends to be somewhat of that equilibrium neutral range here at the moment. And that's what the bond markets are currently pricing in right now, is that kind of neutral rate, even though the Federal Chairman Powell believes that we're now above that neutral rate. 10-year yields, 10-year TLT long-term bonds, showing some positive signs here, risk on signal over the past couple of weeks, but starting to firm up against some resistance here. And the question is whether this starts to sell off here again in a more risk off environment. So we'll see as of this week as to whether bonds respond positively or not. So if we look at the US dollar sold off, unsurprisingly with the dips in the 10-year yield, pausing a little bit, providing a little bit of a check back here this week, back to that 1.3 level, which was our downside target here in the US dollar. We'll see if that can hold as resistance, or if we start to see further declines here. My hunch is that this could end up starting to trade back that range into that 103, 104 range or so. Bitcoin continues to rally here into that $72,000 level here. Bitcoin taking a bit of a pause here this morning. We'll see if this can continue. Certainly currently has a momentum, especially with Bitcoin ETFs garnering a lot of the volume here. Very much could see Bitcoin continue to rally here over the next few weeks. Looking at gold, this is really the big breakout here. Gold breaking out above those all-time highs, above that 2150 level. Excuse me. Above that 2150 level here. Taking a bit of pause here today, but I think that gold really has the potential or the momentum to continue moving higher here, very similar to Bitcoin. So reaching to new all-time highs here as well. Looking at oil, even though attempted to break out here above the $79.80 level here, which has been a firm resistance for many months, so far has retreated back into the trading range. We'll see if this makes another crack here and moves higher, or simply fails at the $79.80 level here. Energy certainly has been a sector that has started to outperform, and we'll see if that outperformance can continue here over the next few weeks. Looking at some of the individual sectors here that I think are worth paying attention to, technology. Even though we continue to grind higher in technology, it's important to see that the relative performance of technology to the S&P 500 has actually been poor over the past few weeks. So technology that has led this market higher here for many, many months, many, many years, at the moment showing some weakness here, starting to trade, showing some underperformance relative to the markets. Consumer discretionary, same thing, made an attempt to make a new all-time highs in XLY, but actually if you look at the underperformance of consumer discretionary, it's been 6 months in the making and it continues to underperform as a sector. Same thing with communications, trading sideways here, starting to underperform the overall market since the beginning of February. Some noteworthy sectors, financials, keeping up with the rest of the market. Financials actually, if you look at it since July of last year, actually continues to outperform the overall market, and certainly one of the sectors worth paying attention to in your portfolio, because XLF outperforming the overall market by this amount is something that we haven't seen in quite some time. Consumer discretionary continues to underperform the overall market. As you can see, higher highs in price continues to underperform the S&P 500. Same thing here for healthcare. Healthcare, despite showing what looks like a pretty positive chart here to the straight up to the right, as you can see over the past 6 months or so, continues to underperform the S&P 500. Materials is really one of the breakout sectors here at the moment. We've seen materials, even though long-term has been an underperformer over the past month or so, has really started to outperform, especially on this big breakout here to the upside. And we see it both in industrials as well as in materials. Breakout higher here, relative outperformance. And that's what you want to see as you're selecting for sectors and individual opportunities with stocks right now, is in sectors that are outperforming, or if you're looking for bearish opportunities in sectors that are underperforming. Looking at real estate, we continue to see real estate kind of push the new recent highs. We're trying to break out to that 40.5 level here. But as you can see, there hasn't been a lot of outperformance here right now. So my expectations are not too high here for real estate. Energy is one of the sectors that is starting to outperform here. As you can see, we've broken out to recent highs above this $87 level breakout here. And there's a slight amount of outperformance that we've started to see here in terms of energy, very so slightly. So we'll see if that can continue here over the next week or so. And utilities as well. Even though we've seen some gains here to the upside, we really have to look at the long-term chart here of utilities underperforming the overall sector. Overall market, and I don't anticipate that to change very much. Home builders, looking at home builders breaking out to new all-time highs. Look at that confirmed by relative outperformance, relatively strong sector here right now. Home builders, we have some of the home builders like Lennar that's reporting earnings this week. We expect that outperformance to likely continue. And same thing with semiconductors. This is really where a lot of the outperformance since October of last year has been concentrated in, versus the S&P 500 outperforming by nearly 26%, 27%. So not only are we seeing gains from an absolute basis, but also on a relative basis. Those are pretty strong things for the semiconductor industry. So with that, what I'll do is I'll leave you with some interesting charts that I think are worth paying attention to here right now. Bristol Myers Squibb. This is the stock that we've been looking at since November. We actually took a small position here on this low here in November around that $49 level. But as you can see, over the past few months, we've seen Bristol Myers form this bottom here around this 53.48 level. And just a couple of days ago, we started to break out here from this bottoming position. So Bristol Myers underperforming for quite some time, showing signs of a bearish to bullish reversal, early signs. This certainly has the initial target here of filling this gap fill, which is just around $56. And if they can fill that, we're looking at substantially higher prices into the low 60s as our upside target here for Bristol Myers. So showing that outperformance, showing that confirmation of the breakout, incredibly strong, worth paying attention to here right now with regards to Bristol Myers. I'll also leave you with one bearish trade that we're currently looking at here, John Deere. John Deere has underperformed the overall market, recently gapped down lower here below this 375 level, managed to trade all the way up to that 375 level, and I think is an opportunity for a short position here as well as momentum continues to remain negative and failing at this gap fill level here at 375. So those are some opportunities to pay attention to here that we currently see in the market that are fresh off of what some of our scans. With that, that covers what I wanted to share with you. I hope that this was helpful in giving you an overview of the broader markets. Like I said, positive macro picture that has started to form here, but overall there are some warning signals with regards to the fact that we are likely near the top of a market, at least due for a short-term pullback. Be very careful about that, but pullbacks can be potential opportunities to be buyers here at the moment. But there are some opportunities on both sides with regards to bullish and bearish markets at the moment. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.